What is a mortgage? What is a mortgage specialist? Should I use a broker or a loan officer? These and many other questions answered by an expert coming right up. Hi, everybody. Welcome back to The Real Justine Priestley channel. I am The Real Justine Priestley, your local realtor with a twist here in the Greater Vancouver area. This video features special guest star Sean Chapman, who is a 29-year mortgage veteran, mortgage Yoda, a mortgage guru, and he's going to answer all of our questions. Let's get into it. This video is part 2. To watch part 1, click the card above. So if I have a pre-approval already in hand, why do I still have to wait and make a subject on my offer of 5 days or 7 days if I already have a pre-approval?
So with a mortgage pre-approval, when we put our stamp on it, we're telling the client, we like you. We like your income. We like your down payment. We like your credit history. We like your debt load. Based on those numbers, this purchase price level is what you can take it to. But you're pre-approved, the client, not the property. We still need to do a full appraisal on that property. We still need to look at that property, make sure it meets our standard guidelines, and make sure that the value is what you've offered. For less than 20% down, we need about, say, 2 to 5 business days. When you're talking 20% down or more, we're looking at usually 5 business days to sometimes even up to 2 weeks.
Right, because it's not just the person and their income. The bank's getting involved with what you're buying also.
Absolutely, they are.
So if somebody makes an offer on a house, nowadays the market, the prices, the value, everything's just skyrocketing. What if the purchase price is so much higher than what the bank is actually getting as an assessment number?
And that's a great question. So understand that we will mortgage based on either the purchase price or the appraised value, whichever is lower. So if the appraised value is higher, purchase price is not an issue. If the appraised value is lower, that could be an issue because it all depends on what that client has to put as a down payment. As an example, if you're buying a property for, say, $1 million, you put that offer at $1 million. You've got $200,000 to put down. You got enough for closing costs. You're good. So we would mortgage you for $800,000. When we go to do that appraisal, if that appraisal comes in at $900,000, let's just say you overbid because you really wanted that property and wanted to beat out everybody else. Well, guess what? We can only finance 80% of the $900,000. That's $720,000. So that means you're buying it for $1 million. We're mortgaging for $720,000. That means you've got to provide $280,000 as a down payment. The challenge being is you only had $200,000 to start with. So that's where we run into issues where if a client puts a no subject offer in and the value comes in lower, they can put themselves in a pretty tough predicament because they'll have already handed over $50,000, $60,000, maybe $100,000 as a deposit. And those are the situations we don't want clients to be put in.
No, but could they maybe borrow the other 80,000 from Uncle Lefty and
when you do 20% down, they do allow us to do some. You can use some borrowed funds for sure. The challenge being is now those borrowed funds have to be included in what we call the debt servicing, the income to your debts. And if that number goes over the 44% max that we allow or that we're allowed to use, then there's a good chance you won't be approved for it. So it's always prudent to make sure that when you put that offer in, if you're able, put subject to financing.
Right. So another reason why that 20% is kind of a golden.
Oh, it is very much so. Very
it's like a sweet spot to aim for when you're getting a mortgage.
If you can do it, it just saves you money. It makes the payment smaller because you get a 30-year amortization. You're not paying like at 5% down on a purchase, you're paying 4% as an insurance premium to CMHC.
Can you please tell me about the recent mortgage interest rate hikes in Canada?
So recently, this week, the Bank of Canada increased the bank rate, the rate that they lend to us at, by 1/4. So that went from 1/4% to 0.5%. As a result, anybody with a variable rate product, all of their rates went up by 1/4. We've also, in the last probably 6 months, had fixed rates climb. And that's based on the bond market, okay, the investment market.
And how does that affect someone's actual monthly payment? Because that's most people, I feel like a lot of this all boils down to what are their bills every month and can they afford it?
Exactly. On a variable rate, it can impact you depending on the lender. As an example, Royal Bank, we have, when you sign your mortgage documents and you buy that property, on your documentation, we have what's called a trigger rate. I'll use 4% as an example. We will not increase your payment until the interest rate hits that trigger rate, or 4%. So from now until that point, if rates are rising, your payment will stay the same. Your amortization will extend out, but your payments will stay the same. Once that rate starts to come back down, then the amortization will shrink, and again, your payments will be the same. If it does end up hitting that trigger rate, then we'll incrementally bump your payments up until the rate hits a peak. And when the rates come back down, we will lower your payment back down to what it was previously.
And can you please explain to me what the stress test is?
In Canada, we have a stress test that we're required to use by the federal government. And the point of it is, it's 5.25% currently, but the point of it is that the government is saying, look, if rates were 5.25%, and based on your income today, based on your debts today, based on that mortgage you're trying to get, if your rate was 5.25%, would you be able to afford that? And that's the number that we have to work with. Once you're approved, then you get to choose the interest rate, the term and the interest rate that you want to take. But we have to qualify you at 5.25%.
And that's a great opportunity for you to smoosh the like. Smoosh.
So currently, you could take a 1.85 variable, or you could take a 3.29% 5-year fixed, as just examples. But that stress test is just to say that down the road, based on what the mortgage you're about to take, if rates did go up, could you afford it? And really, it's just to protect clients, to say, hey, you know what, if rates do go up, you know that you've been approved at this level. That means, down the road, you should be fine.
Let's talk a little about foreclosure, because I think there are a lot of misunderstandings about foreclosure. What I understand is that banks do not want any foreclosures, right?
None. The last thing any lender wants to do is foreclose on someone, because it leaves a very bad taste in their mouth and in ours. So we do our due diligence at the time of application to the best of our ability to make sure we don't run into that. Now, with the values that we're seeing in BC and the fact that they're continuing to rise, our foreclosure rate is very low. Maybe down the road we might, if the values ever do maybe dip a little bit, but for now, we don't see very many.
I can't imagine the values really ever crashing in Vancouver. Can you?
Well, it's, what it is. I tell people, it's all based on supply and demand, just simple supply and demand economics. At the end of the day, we've got a big demand. We don't have a lot of land to work with. So I don't, as you say, I don't see the values crashing, but the values for the most part, I think they'll level off at some point, maybe dip a little bit. What I like to say to my clients is just be in the market, just get in the market, so that, because you've either got to pay a mortgage or you have to pay rent. The only other option is you live at home with your parents. And rent right now is astronomically high, which is why we're seeing so many more people wanting to buy, because it just makes more sense. You want to pay your own mortgage. You don't want to pay somebody else's mortgage.
Yeah. I think the big hurdle for so many people is just getting together that down payment, though.
I agree. I mean, at the end of the day, getting together 5%, even on a $500,000 mortgage, is $25,000, right? But that's doable. It's when you say to people, well, 20% down, okay, now you're talking $100,000 on a 500 purchase, or $200,000 on $1 million, right? So it is definitely challenging. But as we discussed before, the parents are starting to step up. Parents, I'm starting to see more parents go, hey, if you're going to buy real estate, we'll help you out.
Yeah, and like you said, like with the values going up, the equity builds in the home so quickly, like really even just in 1 or 2 years in a lot of cases.
You got it.
So yeah, so that's nice. What is something that you wish that all the different clients that you work with and come to you knew more about, or what do you wish they understood?
The most important thing when it comes to doing what we do is pre-approval. And I know it sounds simple. I know we've already talked about it, but I wish everybody would do it. It's so important to make sure you find out what your max, what I call purchasability is, because you're not going to do yourself any favors, or the realtor or the lender, if you're just going out there trying to find find a place, you find the dream home you want, you put that offer in, and then you get declined. And that's a tough thing to take.
I don't think that clients should ever look at something that's above what they can afford, because the more
Absolutely.
expensive thing is always going to look better. And
Yep.
then you're feeling like you have to step down. So I think it's super important to know what you can afford and then only look under that shelf, up to and under
Absolutely.
that shelf.
Absolutely.
Just because, it's so emotional.
Oh, very.
And I want to even call it a pre-approval, because
Yep.
I feel like there's this kind of misconception out there that getting a pre-approval is something that you do right like a couple weeks before or a month
Yep,
before, you're seriously looking. But what you're saying is find your specialist, find your mortgage person that's going to help you, and go see him 6 months before or even a year before. So Sean, what are the pitfalls that you would like to warn people about anywhere in this process?
I mean, the biggest pitfall for us, in our opinion, is going in without subjects. At the end of the day, you're buying a property, $500,000, $1 million, $2 million. This is an asset. Now, it's definitely an asset. It's definitely an investment. But you want to be able to, number one, make sure you can be approved for it, right? So subject to financing. Number two, you want to be able to do a home inspection. You want to know that a third party is going through that and looking at things that maybe you wouldn't look at.
Please tell me the sort of 101 version of refinancing. What is refinancing?
So refinancing is basically doing an equity takeout, right? It can take many, many forms. But the big part of it is that you're taking the mortgage you've got now and wanting either to make it bigger and take some equity out to use to renovate, to buy another property, to just, like I said, with a HELOC, have that available should you decide to pull the trigger on something else down the road. And the type of qualifying is very similar to the qualifying you did when you purchased that property. No different.
Sean, thank you so much. That was a great conversation, and I hope everyone enjoyed it. And anyone who wants to reach out to Sean, there'll be some information in the description below.
Thank you very much. I very much appreciate it. And thank you so much for having me on. It was fun. This sort of thing I've never done myself, and I definitely enjoyed it. And it was nice actually being asked questions for things that are just normal and part of the job that most people just don't think about.
Yeah, a lot of people don't understand this stuff. Like, you're such an expert, you're doing like classroom talk, but everyone else is just doing like kitchen table talk, and they don't get it. So I hope we illuminated some stuff today for people.
Absolutely. Absolutely.
Okay. Bye, Sean. See you later.
All right.
Bye. Do you have a question about mortgages that we didn't get to in this video? Drop it in the comments. Do you ever worry that you might be annoying your realtor? Well, you're probably not. But if you want to find out more, watch this video right there.